you might recognize me as Budget Babe. And today we're going to talk about the mindset required to become a successful investor. Now, some of you might be thinking, oh, it's so hard. I've been investing for a while now and I don't get as good a track record as, say, George Soros or Warren Buffett or whoever your investment idol or figurehead is. But the key thing to recognize here is that all these best investors are also human, just like us. But what is it that they do that is different from the average retail investor? Well, there's two things. The first, of course, would be the skill. And skills can easily be learned when you take the effort and initiative to go and learn those. Whether you're someone who believes in fundamental analysis or in technical analysis, you would go and learn the different formulas and due diligence research ratios, as well as the charting methodologies and the signs to watch out for, the patterns, and then recognize when to make your entry and exit point. Or if you're someone who wants to marry both FA and TA, you would learn how to do that seamlessly. So the knowledge and skills are set, and as you become more experienced, then you get better with it over time. The other thing though that most people don't really talk about is the mindset. Because it's easy to hear and see things like, oh, buy low, sell high, or average down even when it looks like the market keeps going down. But then you hear all the other stuff like, don't catch a falling knife, and how exactly do you reconcile what exactly is the right move to make? Well, there's one way to it. The best investors are able to do this because they have the right mindset in overcoming their own psychological limitations. Limitations that both you and I and everyone else who are only human suffer from. We've categorized this into three groups: logic, social media induced, as well as emotional. And before you think, oh, that's so hard to overcome because it's an innate human thing, no, remember, the best investors are also human just like you and me. And change starts from being aware. So we're going to talk to you and share with you about the different psychological biases that you need to be aware of in your journey as an investor. And by recognizing it, you'll then be able to implement the right antidote or the solution to overcome it. So in order to do this, I could think of no better person than my fellow co-host Reggie, who I talk about regularly and banter with on our weekly podcast called White and Shine, which is all about mindset and perspectives and how they shape our thoughts, our shared reality, and more importantly, enable us to drive the change that we seek to design the best life possible. Some of you might recognize Reggie. He also runs The Financial Coconut. So Reggie's going to be talking to you guys about the different psychological biases, and as we go through this, I want you to be thinking, which one do you recognize and seeing yourself? You might be nodding your head throughout as you're like, oh yeah, I definitely was guilty of that. Well, take note of that, write it down if you have to, and then once you're more conscious, you'll then be able to act on what you need. And as a bonus, at the very end of this presentation, Reggie and I will also share with you what we personally suffer from as investors. That's right, you're not alone, even we have these limitations. But when we are aware of it, that's when we can act to change it and prevent it from overloading over us. So without further ado, let's join me in welcoming Reggie.
Very happy to be here with all of you today. I'm your host Reggie, aka your Chief Financial Coconut. If you have not consumed my podcast, then take out your phone now, right? Like, share, subscribe, right? Hey, wait, can I get a show of hands? Do I have fans in the hall? Anybody know? Oh, thank you, lovely. Yes, later we take photo. Oh, yes, later we take photo together. Okay, so I run a weekly show with Dawn. Called Wise and Shine. I think she shared with you. Talk a little bit about mindset, different perspectives of life, But today, because it's an investment event, we're going to talk a bit about the investment mindset, right? So some things that you fall short of, even we also fall short of, and some simple tricks, right? Not some complicated algorithm that you need to establish in your life to try to counter some of these problems that you face. Okay? Okay, yeah lah. Beautiful show. The Financial Coconut is on YouTube. Okay, follow, like, share, subscribe. Okay, so very simple, some of these behavioral biases that you have. I think, broadly speaking, there are some things that are more logical, some things that are more emotional, some things that are more like external, right? So logic, sometimes people think logic is superior, right? But we have gaps in our logic. As we go along in our lives, we also realize this thing, right? Sometimes we think this thing works, but over time we realize we gather new information and whatever logic that we used to hold to has flopped, right? So we're going to talk about some of these things. And of course, the emotional side of things, right? As you're investing, I know How many of you have heard this idea called put your emotions at the door when you're investing? Can I see a show of hands? Right, remove your emotions, right? It's so common. But the reality is the emotions tell you so much about who you are, what you're doing. If you're feeling uncertain, your emotion elements are acting up, essentially it is a good sign that you may not be very clear what you're doing. Right, so rather than suppressing our emotions, I think it's really about working with them. So we're going to go through some of these things also. And of course, social media, right? These days, social media is everywhere. I cannot say too much bad things about social media because I also influencer, right? Like, so I cannot say bad things about myself, but I'm going to teach you how to consume social media in a better way, especially when we're talking about investing, right? Not just makan shows, huh? Okay, we're going to go through some of these biases that people have, and the first thing, of course, is anchoring. Okay, so the first is very simple. When you enter a stock, you have a certain belief, or when you buy a certain investment, you anchor on certain facts. But over time, some of these things have evolved, right? Facts are only as good as they are today. Eventually, if there are new things that change, these things evolve. And a lot of times, we may not wake up to the reality that, actually things have changed. Only when the market comes down, they'll be like, yeah, I think very jialat, yeah, it has changed. Right? So this is the reality. What I would recommend a lot of you to do is have a regular check back on your thesis. Right? How many of you actually runs an Excel sheet or something that, you write down some of these things? Can I get a show of hands? Very good, lovely, all my listeners. Very good, shout out to you. Yes. So you should document your theses, write them down. It doesn't need to be very sophisticated, but as you write them down, it's a brain dump. Over time, you keep checking back. Right? Every quarter, there's new information. Every year, there are new things. Right? So you keep checking back. It's like writing a book. Eventually, if you exit the book, you also know why, okay, this book cannot continue already. Right? So having regular checks is extremely important to keep up with the anchors that you hold in your investment thesis. Okay? Next thing is overconfidence. Don't need to elaborate. For different things, especially sometimes when we are in the industry, it's so common we believe that we know better, right? Circle of competence. Have you heard of this thing? Buffett talks about it, right? Circle of competence. Sometimes you run you're an engineer in the engineering field, so I know this, right? So it's so common to have overconfidence, especially if you're really good at what you do. So how do you go about countering overconfidence? The best thing is to have a group. Right, have a stock group, okay? I know all of you have a group. You hang out with your friends, you go cafe hopping. Sometimes you gossip about Sally, you gossip about your friends at work, you gossip about the kids. Why not talk a little bit about stocks, right? Have that kind of group to come together to talk about things, trash your thesis out, my view is this, blah, 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 blah. Right? And then someone else has another view, blah, 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 right? So having that group to anchor and kind of talk through does check your confidence a bit, especially when your friends are like, wow, very edgy one. Right, so like my friends are like Dawn, right? She's very edgy, right? So when you have that, you have at least a basis to kind of work around rather than just yourself. Okay, so great to have a stock group. Don't always talk about just where to go and eat, Okay, talk a little bit about stocks. I think it's good. Next, confirmation bias, of course, is very simple. It's very easy to understand. When you look at something and you confirm it, it's an extension of overconfidence. Eventually, you come out on the other side and you realize that, maybe it's not as accurate anymore, right? So one thing that you can go about solving this confirmation bias essentially is to kind of highlight some of the risk factors that you have. Okay, because a lot of people, when they go into the stocks, once they decide that this is it, all the risk factors become not important. You are called the diamond hand, right? Like today the word is diamond hand. We go hold all the way to the end, right? But when you can highlight these risk factors in your investment, it is not about discounting them, but it's about recognizing them. When you write them down, you can periodically come back and check. Okay, let's say the factor here is if this brand no longer is number one, then the whole thesis collapses, right? That means there's a competitor that comes in today. So when you write down this risk factor, at this point in time, it doesn't exist. But when you see that there's a new competitor that comes in, it's a very quick check. So, things have changed, right? So writing down these risk factors will check your confirmation. I think that is very, very important, okay? So of course, hindsight, when things happen, you come out and say, yeah. How many of you have heard of the Amazon story, the Microsoft story, the Facebook story? It's like everybody tells you that something is going to happen at the end. And then when they come back and say, hindsight is 2020, right? That's the reality. So growth investing becomes a very difficult concept because how do you know what's going to happen, right? What are some parameters that you work with? And all these on top of your thesis has some mindset elements to it, right? So of course, the easiest way to go about doing this, simple way, is to not just have one scenario on your investment thesis, but have a best case and a worst case, right? And you see that actually a lot of the analysts, when they give you certain reports, right, their graph got 3 directions on, right? So they have one graph in the middle, and then they have one graph of like best case, and one graph of the worst case, right? So I know a lot of times you receive analyst report, you're like, Sienna, don't know what they're writing, but actually there is basis to it, right? So maybe in your own research and your own investment thesis, you should have this, right? So with this element, it kind of checks that, okay, if it overperforms, great. Right? If it underperforms, also great. At least you have some clarity there so that it doesn't kind of muffle your view going forward, right? To believe that hindsight is 2020 lah. Are you following? Okay? Easy to understand? Okay, very good, lovely. Right, so the next thing, of course, is what we call representative bias, right? In other words, sometimes we associate things to be like, if I like this founder, I'm sure you've heard this, right? Who invests in Tesla? Can I have a show of hands? Oh, okay. Well, raise hands very paiseh. That guy just like, 6 months ago, he'll be like, right? It's different, right? And it's okay, it's fine, right? We learn as we go along. The reality is sometimes we like somebody or we like a product, and by extension, we believe that the business is good. It may not be true, right? You may use certain cosmetics, you love the product, it is one of your favorite products, but is Estee Lauder the best company? Probably so, right? So that's a different discussion, right? So depends on this extension or idea, it is not a definite transition. Okay, so separate the individual, separate the product, separate the business. Some product can be great, but they can be of a horrible business model. I don't know if you guys heard of this company called e.l.f. Right, it's a cosmetic company. They had a very horrible business model, but they have a great product in the States. They changed their business model, and their business model works after that. Right, so these are some realities. When you separate these things, you don't let that belief kind of cross through into other facets. Okay, so can have a fancy founder, but does not mean have a great business and a great product. Huh? Okay, of course, next one, narrative fallacy, essentially this is very prevalent in today's world. I mean, when you're all over the internet like me, right? So everybody kind of judge what you say, what you talk about, and you have all these narratives out there, right? Tesla is gonna change the world, it's gonna like dig the floor, it's gonna do everything, right? So a lot of this narrative style can be a little bit complicated to understand, because if your investing style requires you to believe in a narrative, on some level you cannot run away from this, right? Right, but if you're not anchored on the reality of some of these fundamental factors, right, which when we invest in growth stocks, sometimes it's not just about gap factors, right? Because there's no gap factors in growth stocks, right? You got to look at non-gap, right? So you got to look at the fundamental, like how many cars are we pushing out, right? How many, what is our churn rate? All these are non-gap, but these are important parameters to understand the business, right? And not just buy into a beautiful story, right? A lot of people can sell you great story like myself. You can follow my podcast, okay? Must keep, 不要一直笑我啦, right? I keep plugging, I know, I try very hard, yes, very good. So yeah, of course, read company statements, kind of have a better understanding of landscape, because this is very important. How many of you know Under Armour? Under Armour, great, right? The shirt, very nice, very sweet, right? You go for all the runs, they always have this shirt. But the reality is that Under Armour has been quite a horrible business over the past few years. There was a period of time that they were amazing. They were doing really, really well. But eventually, they kind of collapsed. So if you only read Under Armour's business statements or their early or annual reports, right? Sometimes you get masked by all these narratives, right? Like, wow, we're going to change the world. We're going to be the third largest brand. We're going to like smash Nike. We're going to do all that, right? Especially Intel. Who invests in Intel? Intel is another one. Every year tell me they're going to have a better chip. Every year lose. Right? So every year the CEO comes out and says they're going to do better, but every year they underperform. Right? So it's not just about understanding what they are saying, but cross-comparing the competitors. At least read 2 or 3 other people in the same business. Okay, especially if they're in established businesses like computer chips, retail brands, supermarkets. Read 2 or 3. When you read 2 or 3 of these other competitors, you have a better understanding of the landscape. What are we playing in? Right? If not, your theses will have very weird things. Okay, let's say you read, just for an example, you read, let's say Nike, right? And Nike tells you that, our margins are at like 30%. And then you think like, oh wow, 30%. Maybe they can do 40%. But when you go and read everyone else's report, you realize everybody's at 15 and 20%. So how are they going to do 40? It's quite hard, right? The reality does not stand, although there's a narrative that they're trying to push. Okay, so try to compare other competitors, get a broader understanding of the landscape. So from there, then you can be more anchored rather than always be just buying into narratives. Okay, so framing is iconic today, right? Very common, because every CEO now is an influencer. right? They all can do a great job, doing great speeches. The PR team is amazing. So sometimes when they come in, it can be the same factor like EPS, right? So when they come in, the same factor, EPS, everybody knows earning per share, right? And when they tell you certain things, how they frame the words will affect how you look at the situation. Right, so it's very simple, right? Our EPS is 2.1 compared to expectation of 3. It sounds not so sexy, right? But the expectation was 3, and if they reframe it compared to previous financial year, it was 1.7, right? So if you think about it, if you read the second statement, you think like, wow, this company performed very good, very sweet. But you read the first statement, it's like, this company never performed up to expectation, right? Which was like, I don't know, Tesla for 5 years or something. Okay, yeah. Okay, great. Yeah, so one of the best things is to observe the measurement, non-GAAP especially. Okay, because non-GAAP is very prevalent to have these kind of things, right? So watch out for changes in measurements because companies do from time to time change their measurement index, and I'm always very iffy when management change the measurements, right? Because why are you using a new barometer or new parameter to evaluate your old business? Okay, you must ask them and grill them, right? Prospect theory. Okay lah. So how many of you do this? Just show of hands. You sell your winners, you keep your losers. Okay, I don't want to show hands, it's okay lah, I get it lah. Right, so this is very common, I understand, because it doesn't feel good, right, to have your losses, and you feel like, okay, paper loss is okay. Right, but depending on your investment style, I will leave it to you to do that. But the reality is, if there was one thing that you can take away, winners can keep winning. Losers can keep losing, right? So it's not a yes or no definite kind of situation. The next biggest Disney will probably be a Disney, right? So these are just some ideas that I think you should think about rather than just keeping your losers and selling your winners. Okay, gambler's fallacy. It's easy to understand. Luck is a hard thing to establish, but we will talk about it by extension of it, right? So if there was one thing for you today, is hope is not a plan. If you listen to my podcast, you'll hear this a lot, right? A lot of people say, I hope for the market to come back. I say, hope is not a plan. Okay, a plan needs to have probability and it needs to be executed, right? So don't sit there and hope. If you are in a hope, if you're already in the hope mindset, hoping this works, right, then you really got to sit down and recalibrate what's going on. And the best thing is talk to your stock group. Right, your stock group is supposed to be there to support you. And it does not even need to be a group that you pay money for. It can be a bunch of friends that you're trying to hustle towards, a bigger financial goal, and that group can anchor your ideas, right? And overreaction, this one you also understand, very simple, right? You don't overreact in the sense of buy much higher than what you need and all that, right? So to me, this is one of the best things that I think everybody should do. I know FSM will not agree with me, but at the event of the broker, I will tell you, after you use the broker app, delete it. Okay, after you use the broker app, delete it. When you want to use the app again, you download again, right? Because it creates friction in the way you execute your trades. Okay, especially if you're a long-term investor, these days it's very easy to just trade, right? You go in, you click, and then when the market's out there, the news is coming, it's like, I need to sell, or I need to buy, and you have no friction because it's just on your phone. And sometimes notification come in, right? Tell you, we have a new bond offering. Have you ever received that? Okay, I also FS1 client, so I know, right? So the idea here is, as much as the platform is good, the fees are reasonable, if you keep getting bombarded by these kind of things and you have an easy platform to transact, it's not great for your investments, especially if you're longer term. So once you make your action, once you have transacted, delete the app, come back again when you need to. Okay, so when you need to transact again, download again. Right, you can download, face scan, everything, adds friction. Okay? Herd behavior, normal, everybody understand, right? Majority in numbers. Okay, but at the end, I think this is something that a lot of people already know. You gotta ask yourself, like, would I still hold this stock if everyone else is not? Which is why, once again, I point you back to the stock group that you should establish amongst your friends. I think this is amazing because when you have that, it's like there are 5 people, you're all investing for a better future. You sit down, right? And then you have a total different thesis against everybody. Right? It's like you watch soccer and then you support Arsenal, everybody support Man U like that. Right? So it's the same idea, right? If when you're alone and you're still willing to do it, then it may be a good choice. It may not be, but it depends on your beliefs. Okay, so the last thing, of course, I think this is the last thing, right? Yeah, the last thing is to appeal to. I left with 1 minute. Okay, the last thing is to appeal to authority. But these days the authority figures have changed. It's very cute, right? Authority figures are no longer great investors. Like influencers like me become an authority figure. So remember, you need to have your circle of competence, right? Follow the people that matters. I would recommend you to read more than watching videos, okay, although I create videos. So I read first, then I create a video, right? So if it's simple for you, you can watch, okay, great. But if you truly want to be an investor, reading is still the base, right? All the research are written, everything is written, right? So you should go and read more and don't just keep appealing to authority and just listen to the people that are up there lah. Okay, so great. Okay, I say a lot already, not enough time, we overrun. Right? Okay. Yeah, just to close it off, these are some of the things that even we struggle with. It's not necessary that you're alone. Right, so if you have any questions, listen to the podcast. If you have any question, I'm out there, we can chat. Okay, that's it. That's all the time I have, right? Okay, thank you. Bye.